Welcome back to another episode of The Investment Advisor. I'm your host, Matthew Stevenson, in partnership with Dukascopy TV. Remember, money can take care of you, it cannot take care of itself. What's up today? We're going to look at the shares of Amazon, not the jungle, the online retailer, but it is an Amazon of a kind in that it dominates the world of retail sales. Stock is expensive, so the question for our listeners is, do we want to hold it? Do we want to buy it? Do we want to sell it? Let's look at some of the basics on Amazon. You can see from this chart, anyone who's owned Amazon for the last 10 years has had an extraordinary run. Shares were trading at, say, $35 a share in 2005, and in 2015 they're up to about $423, $24. An extraordinary run, a very successful run. Amazon's a good company, there's no question about it. You have those little brown boxes stacked up in a corner of your house, and every once in a while you click on a few things and they arrive. Generally people are happy, probably not always, but in general customer satisfaction is very high with Amazon. And they like the prices, and they have liked that many of the products have come to them tax-free or sales tax-free. But such success comes at a cost. At least it comes at a cost to anyone who's now thinking of saying, is this a stock that I want to buy? Well, there's a few numbers out there, and they may not be the numbers that you want to hear in connection with Amazon, but I'll give them to you anyway. The price-earnings ratio of this stock is 95 times. Well, the new thinking about the market says, wait a minute, PEs work for railroads in the 30s. They don't work for technology companies like Amazon in 2015. What you've got to look at is that they have technological advantages, they have market reach. Want to hear a great number? They have 278 million active customers around the world, many of those in the United States. But if they were all in the United States, it would mean everybody, every man, woman, baby, and child in the United States was a customer of Amazon, pretty much. Another thing about Amazon it's a bit daunting is that its price to book is 18 times. Again, stratospheric number. But let's give us the good news. Let's look at revenue. Revenue since 2012 was about $60 billion. Then in 2013 it was $74 billion. 2014, last full year, closer to something like $89 billion. So the revenue growth is there. The market share is there. The problem is, what do you have to pay to own this stock? You've got to pay $423 a share and hope it grows to what? 500, 600, 800? Could well do it. Basically, there have been no down years for Amazon in the last 20 years. So that's the decision you have to make. Is the operating margin, a little bit that they keep on every package they send out to you, something that will remain in place? If not, I think the stock is as fully valued as any stock on earth has ever been. I like Amazon. They sell a few of my books. Maybe they could sell a few more. They make a lot of people happy around the world by their pricing advantages and by their fulfillment services. But they have 114,000 employees globally, and they have to keep growing. And of recent years, one of the criticisms of Amazon, it hasn't been able to invest money efficiently in new projects. The old model has always worked, and selling more lawn chairs or more books or more CDs has worked for them. But there are competitors out there. My conclusion here on The Investment Advisor, for me, $423 a share, a PE of 95, price to book of 18. I know I'm looking at a methodology that worked for railroads, as I said, in the 1930s, but too rich for my blood. Well, that's all the time we have today on The Investment Advisor. I'm your host, Matthew Stevenson, in partnership with Dukascopy TV. Remember, money can take care of you. It cannot take care of itself.